Hi, welcome back to Joe Blogs. In today's episode, I want to talk to you about what's happening in the Chinese economy, and specifically to talk about some very worrying figures that have just been published showing industrial profits for the first quarter of 2024. Now, at face value, these figures actually look quite good because over the whole quarter, industrial profits were up by 4.3%. So you might be sitting there thinking, well, that sounds like pretty healthy growth. Why are you concerned? Well, when you look into the details as to how that percentage was arrived at, in the first 2 months of 2024, industrial profits were up by more than 10%. However, in March, they were down by 3.5%. And this shows us a continuing trend that we're seeing in March for Chinese businesses and the Chinese economy struggling to make any profit. And the reason for this is because of what's happening both in the global economy and also the Chinese economy itself. Because Chinese businesses are geared up to produce huge volumes of products. And those volumes are sold both in China and everywhere else in the world. And when the global economy starts to slow down and decide that it maybe doesn't need to buy as much stuff, then China starts to suffer. And in those circumstances, industrial businesses in China then turn to the home market and try to make up the shortfall in sales. But the problem that businesses have right now is that China is in a deflationary cycle. Prices are going down. And from an industrial point of view, prices have been going down for a very long time. So in today's video, we'll have a detailed look at what's gone on with industrial profits. We'll look at the breakdown of those figures and establish exactly what's happening. And there's actually a really worrying trend when you compare this year on year against what was happening in March 2023. We'll then have a look at what's going on with regards to producer prices, the factory gate prices, because that's one of the things that's really biting into industrial profits in China right now. We'll have a look at what's happening with inflation in China. We'll talk about what happened to exports in March because they crashed to their lowest level for a long time. And this is a very worrying situation from China's point of view because the whole economy is dependent upon exports. We'll then have a look at a FITCH report that was published recently, which has downgraded the whole of the Chinese debt situation. And FITCH are concerned about what's going on in China, so we'll have a look at the details as to what FITCH has said. We'll also have a look at what's happening with the Chinese yuan, because that's an important part of all of the equation for the profitability of these businesses, because when they're selling their products overseas, obviously they have to then translate all of that income back into yuan. And then finally today, I'll wrap up with my summary. So what I think is happening right now in China and what's likely to happen over the course of the next 3 to 6 months. But before we get into all of that, I'd like to say thank you so much to everyone that's supporting the channel. It really, really means a lot to me. I know I've said this a lot in recent videos, but the reason that I'm saying it is because it does mean a lot to me. So if you've bought me a coffee or sent me a YouTube super thanks recently, thank you for the time and effort that you've taken to do that. I really appreciate every single one of those. I do see them coming through. I see the messages. I don't get time to respond to every single one of them, but thank you for sending them. And if you're a long-term supporter of the channel, either through Patreon or Buy Me a Coffee membership or YouTube membership, thank you for that support. It really helps to keep me motivated. It makes me think that I need to keep producing more content to keep you guys happy. So it's becoming a really nice virtuous circle. So thank you for that support. It helps keep me motivated and keeps me posting more videos like this. In the world of business, profitability is absolutely critical. You need to make a profit in order to be a viable entity and therefore survive in the long run. Now, you might be sitting there thinking, well, ho, hang on a minute. Some of the biggest businesses in the world didn't make profits for a long period of time. Companies like Google and Apple and Tesla and Nvidia. But those businesses are technology businesses and the world has changed slightly over the last 10 years. Investors are now prepared to take a much longer term view if they know that a company is going to be gigantic once it gets to the point when it's actually turning a profit. But for the majority of traditional businesses, profitability is something that they absolutely need to focus in on, and you need to make a profit in order to keep paying all of your costs and continue in the long term. And for the majority of Chinese businesses, which are actually producing things, they're manufacturing businesses, they have that old school method of needing to make profits in order to keep going. And the problem that China has right now is that it's just released its latest figures for industrial profitability for the first quarter of 2024. And whilst the headline profitability growth of 4.3% for the first quarter of 24 looks like a good outcome, when you dig down into the details, there is a very worrying trend. This chart shows the year-on-year movement in industrial profitability for major Chinese corporates over the last 12 months. And what we can see here are some really interesting results. Back in March 2023, year-on-year industrial profits fell by 19.2%. That is an absolute collapse in anybody's books. If your profits are down 19%, you've got some serious explaining to do to your investors. And as you can see, profitability remained in negative territory for the following 4 months, falling year-on-year by 18.2% in April, 12.6% in May, 8.3% in June, and 6.7% in July. In August 2023, there was a remarkable increase in profitability to 17.2% year-on-year. However, that increase proved to be short-lived and fell to 11.9% in September and 2.7% in October. Now, in November 23, as the COVID restrictions finally started to get lifted in China, industrial profitability increased by 29.5% year-on-year. And at that point, the Chinese authorities were hopeful that Chinese businesses had turned the corner and that they were going to start delivering year-on-year profits on a consistent basis. However, year-on-year profitability fell to 16.8% in December 23, 10.2% in the first 2 months of 2024. And in March, Chinese businesses recorded a year-on-year fall in profitability of 3.5%. Now, in itself, a year-on-year fall of 3.5% would be quite worrying. But when you compare it to what happened in March 23, where there was a 19.2% fall year-on-year compared to what happened in 2022, the fall of 3.5% in March 24 becomes even more worrying, because when you combine those two annual falls, the fall compared to where China was in profitability in March 2022 is absolutely huge. And if we take a step back and look what's been happening with this chart, in 6 out of the last 12 months, industrial businesses in China have recorded year-on-year losses. And as I said right at the start of this section, profitability is key to the long-term viability of a business. So if you're continuing to return losses, that means that your business might not be viable. So what's going on with Chinese businesses? Why is profitability falling? Well, generally speaking, when you're talking about profitability, it has a direct link to what's going on with your income. If your income is going up, then generally speaking, if you're running your business well, then your profits should be increasing. If your income is going down, then that might be reducing your profits. And a company's income will be the combination of the volume of sales it's achieving and the price that it's managing to sell those products for. So let's start off by looking at what's going on with producer prices in China right now. This chart shows the movement in producer prices in China over the last 12 months, and producer prices are also referred to as factory gate prices because it's the price that a product leaves the factory at. So this is basically what the company will receive for every one of those sales. And what this chart shows is that in every single one of the last 12 months, producer prices have been falling in China. In April 2023, year-on-year prices fell by 3.6%. That fall increased to 4.6% in May and 5.4% in June, and has remained above 2.5% in every single one of the last 9 months. And so far in 2024, year-on-year prices have fallen by 2.5% in January, 2.7% in February, and 2.8% in March. And if we expand the chart out to show what's been happening over the last 5 years, you can see that this falling trend in producer prices hasn't just been going on for the last 12 months. It actually started in October 2022 when producer prices fell by 1.3%. And in every single one of the last 18 months, producer prices have been falling. And this is very concerning from China's point of view, because the last 6 months worth of figures are compared against the previous 12 months, which represented a fall. So we've got a compounding fall here. Prices are going down compared to where they were last year, and last year they were down compared to where they were the year before. And the reason that this is so concerning from China's point of view is that China is a producer, it's a manufacturer. So it's buying in lots of raw materials from all around the world and then using those raw materials to produce finished products. And as you'll know if you've been following the channel, I'm sure everybody knows this, over the last couple of years, most countries have struggled with high levels of inflation, double-digit inflation in many situations. So what that means is that globally, prices have been rising rapidly over the last 2 years. Inflation is now coming back down in some of the more advanced nations. However, it still means that prices are going up. Just because inflation has reduced from, say, 7% to 4%, it still means that prices are rising year on year by 4%. It doesn't mean that prices are falling, and I think that's a quite common misconception when people see that inflation's coming down. They assume that prices are coming down. They're not. They're still going up. It's just the rate that they're increasing is slowing down. And from China's point of view, those high levels of inflation that have been experienced all around the world for the last 2 years have been wiping out all of their profits because they're continuing to buy in raw materials at higher and higher prices. But at the same time, the factory gate prices in China are going down, and they've been going down for the last 18 months. So that means that all the profitability is being squeezed, because if you're buying things in at a higher price, but you're selling your products at a lower price, by definition, you're losing profitability. Now, in terms of assessing the outlook for Chinese businesses, they have two markets, the export market and their home market, selling things in China. So let's have a look at what's going on with the export market, which is the biggest market for most Chinese businesses. This chart shows the year-on-year movement in the value of Chinese exports, and the scale on the right-hand side of this chart goes from plus 12% at the top to minus 17% at the bottom. And what this chart shows is that in 7 out of the last 12 months, exports have been in negative territory. So that means that China has seen a fall in its exports in the majority of months over the last year. And actually, when you look at the scale of the pluses and the minuses, you can see that the year-on-year fall in the months where exports have fallen has been greater than the months where exports have increased. In May 23, exports fell by 7.3%. In June, that fall accelerated to 12.4%. and hit 14.3% in July. In August, exports were down by 8.4%. In September, year on year, they fell by 6.8% and 6.6% in October. Now, in the last 2 months of 2023, exports returned to positive territory, growing by 0.7% in November and 2.3% in December. That increased to 8.2% growth in January, and at that point, the Chinese authorities were hopeful that the export market had returned. However, in February, the year-on-year growth reduced to 5.6%, and in March, it crashed to a fall of 7.5%, which represents a negative swing between February and March of over 13%. And if we expand this chart out to show what's been happening over the last 5 years, you can see that in line with producer prices, exports have been struggling since October 2022, when they fell by 0.3%. And over the last 18 months, there have only been a few months when China has actually recorded positive growth in exports. The trend over this period has been downward. So what's been happening with exports over the last 18 months goes a long way to explaining why companies in China are now recording a fall in profitability, why they're recording losses, because their biggest market is the export market. And these companies are geared up to produce huge volumes of products. And if they can't sell them, the only other option they have is to reduce the price to encourage people to buy. But if you've got a slowing global market, sometimes reducing your prices doesn't actually achieve your end game. It doesn't get you higher volume sales. All it does is cut the profitability that you're making on the sales that you're actually delivering. And that's one of the problems that Chinese firms are now facing. So let's have a look at what's happening in the Chinese market, which is the other alternative market for China to sell its products into. This chart shows the year-on-year increase in retail sales in China over the last 12 months. And the scale on the right hand side of this chart is a percentage and goes from 0 at the bottom to 20% at the top. And what this chart shows is that over the last 12 months, there have been 3 distinct trends in the Chinese market. In March, April and May 2023, there was a strong increase in retail sales, increasing by 10.6% in March, 18.4% in April and 12.7% in May. However, in June 23, the year-on-year movement reduced significantly to 3.1% and fell further to 2.5% in July. Now, over the next 4 months, the situation improved, with retail sales increasing 4.6% in August, 5.5% in September, 7.6% in October, and hitting a peak for the second half of the year of 10.1% in November. However, over the last 3 months, we've seen that situation reversing, with retail sales growth slowing to 7.4% in December, 5.5% in February, and 3.1% in March. Now, if we take a step back and look at this, you might think, well, overall, these look like pretty positive figures. Even 3.1% in March 24 seems like a good outcome. However, what you need to take into account is that the Chinese authorities have set a growth target for China of 5% for 2024. So, on average, therefore, you would expect retail sales to need to be at least 5% to support that growth. So 3.1% growth in March is significantly below that 5% target. However, what you also need to take into account is what's happening with prices, because it's all very well if retail sales are growing, but if prices aren't growing at a significant rate, then that means that the companies that are selling into this market may actually be selling at a loss. This chart shows the official inflation rate in China over the last 12 months. And what this shows is that over the last 9 months, China has been suffering from deflation. It's actually seen a fall in prices in 5 out of the last 9 months. In July 23, prices fell year on year by 0.3%. They then increased slightly by 0.1% in August, remained entirely flat at 0% in September, fell by 0.2% in October, 0.5% in November, 0.3% in December, and in January 24, year-on-year prices fell by 0.8%. There was a slight bounce back in February when prices increased by 0.7%, and in March 24, year-on-year prices increased by 0.1%. So what this data tells us is that over the last 12 months, prices in China have increased by 0.1%, which is basically nothing at all. So that means that any company who's had an increase in costs, whether it be labour costs or raw material costs or leasing or electricity costs or anything that goes into the costs of a business, any company that's seen an increase in costs over the last 12 months in China will definitely have seen a fall in profitability because the sales prices have only gone up by 0.1% on average. However, as we just discussed, producer prices have actually been falling. And what this tells us is that companies in China can't turn to the Chinese market to save them. In normal circumstances, if the export market dies down, Chinese businesses may have been able to try to sell the excess products into China to recoup some of those profits. But because of what's happening in the Chinese market, that isn't going to happen. And that means that these companies are in real difficulty. One of the other important factors if you're a business that exports all around the world is what's happening with the exchange rate of your home currency, because the majority of your costs will be in your home currency. You're having to pay people in your local currency. You're generally paying for things like electricity and leases and other corporate costs, and you may also be paying for some of your raw materials in that currency, albeit a lot of Chinese businesses are importing raw materials. So let's have a look at what's going on with the exchange rate of the Chinese yuan. This chart shows the exchange rate between the US dollar and the Chinese yuan, two of the biggest currencies in the world, over the last 5 years. And the reason I wanted to go back 5 years is to show the significant decline in the value of the yuan. On the 21st of February 2022, which interestingly was the day before Russia invaded Ukraine, $1 was trading for 6.4 Chinese yuan. Today it's trading for more than 7.25 yuan, which means that over the last 2 years, the yuan has fallen in value by around 12%. And when you think about the exchange rate in the context of an exporting business based in China, that fall in the value of the yuan should actually represent good news. Because if you think about a product that a business is producing, and let's say it costs 7.25 yuan to produce that product, in February 2022, 7.25 yuan equated to around $1.13. So that product would have been selling in America for $1.13. However, that same product today, if it's still costing 7.25 yuan to make, would be selling in the USA for $1. So over the last 2 years, there would have been a fall of around 13 cents in the sale price of that product, making it cheaper and therefore potentially more attractive to buyers. Now, obviously, for the purposes of this illustration, I'm keeping things simple, so I'm not factoring in things like inflation. So don't bother dropping me a comment about that, because we're trying to keep things simple. But over the last 2 years, basically any company that's exporting to the USA from China would have seen the sales price of its products falling, or alternatively, if they kept the sales price the same, they should have been making more profit. And I think what this exchange rate analysis is telling us is that what's happened with the exchange rate for the Chinese yuan should have actually been positive for Chinese exporters over the last 2 years. They could have potentially been making either higher sales or more profit, or both. But what we're seeing from the data is that those companies are now recording less profit. They're actually into negative territory. And that is a major concern for those businesses, because if the yuan was actually to strengthen in value, that would move against them and could make things worse. So the situation is really quite critical for a lot of these businesses. As I mentioned at the start of today's video, Fitch, one of the largest rating agencies in the world, recently downgraded its outlook for China. So let's have a look at exactly what Fitch have said. On the 9th of April 2024, Fitch Ratings revised the outlook on China's long-term foreign currency issuer default rating to negative from stable. Fitch have said that the outlook revision reflects increasing risk to China's public finance outlook as the country contends with more uncertain economic prospects amid a transition away from property-reliant growth to what the government views as a more sustainable growth model. Wide fiscal deficits and rising government debt in recent years have eroded fiscal buffers from a ratings perspective, and Fitch believes that the fiscal policy is increasingly likely to play an important role in supporting growth in the coming years, which could keep debt on a steady upward trend. Contingent liability risks may also be rising as lower nominal growth exacerbates challenges to managing high economy-wide leverage. Fitch have forecast that the general government deficit will rise to 7.1% of GDP in 2024, compared with 5.8% in 2023. And the 2024 deficit will be the highest since the 8.6% GDP deficit in 2020. Fitch is also concerned about the level of government debt, which is forecast to rise to 61.3% of GDP in 2024, compared with 56.1% in 2023, and represents a clear deterioration from the 38.5% seen in 2019, when debt was well below the peer median. Fitch is now forecasting the debt ratio to rise to 64.2% in 2025 and nearly 70% by 2028, which is higher than their original forecast of just under 60% in the previous review. Another key risk that Fitch have identified is the debt that's been built up by local government financing vehicles. And if you're interested in finding more out about this, I'm in the process of making a video right now that will be posted over the course of the next week or so, so please watch out for that. In terms of GDP growth, Fitch is forecasting moderate growth of 4.5% in 2024. Compared with 5.2% in 2023, and the Chinese government's target of 5%. And they believe that persistent property sector weakness and subdued household consumption will bring GDP down. Fitch is also concerned about the deflationary risks which have emerged over the past year amid weak domestic demand, and are forecasting that GDP growth will remain at around 4.5% through to 2028. So what's the summary and conclusion today? Well, I wanted to post this video because I think what's happening with industrial profitability in China right now is a really important metric to look at. And as I said at the beginning of today's video, profitability is key for most businesses, particularly if you're in manufacturing or production, a traditional business that isn't talking about its value in 3 or 4 or 5 years' time. It's talking about what's happening now. You need to make a profit in order to generate cash, in order to pay all of your costs, and therefore continue trading. And what we've seen from the figures for the first quarter of 2024, at face value, look fine. 4.3% growth overall is not too far away from the 5% growth that China's forecasting for the full year of 2024. So you may be sitting there thinking, what's the problem? Who cares? They're broadly in line with what they said they were going to do. But when you dig down into the detail, you can see that 4.3% was made up by 10.2% growth in January and February, and a 3.5% fall in profitability in March. And that 3.5% figure is absolutely critical because that tells us that over the last month, those companies have been making losses. There's been a fall in profitability. And for a lot of companies in China, they're working on very thin profit margins. Their game is to sell volume, large quantities at a low profit margin to generate their profits. So when you get a fall in quantity, it very quickly turns your profit into a loss. And that is a big concern for a lot of Chinese businesses. And we've looked at the details today as to what's driving those problems. And the two main issues are a fall in exports, 7.5% down in March. And for a country that is entirely dependent on exports, that is an absolute disaster. We've talked a lot about the property sector in China over the last couple of years, and property makes up around 25% of GDP, but the lion's share of GDP comes from exports. China makes things and exports it all around the world. Made in China is something that you'll find on things all around your house. That's what China does. It produces massive volumes and sells them to everybody. So when exports fall by 7.5%, that represents an absolute disaster. Because if those export quantities are reducing, Chinese companies don't really have anywhere else to go. There isn't another globe to turn to sell that excess product. The only other option they have is to try to sell it into the Chinese market. But what we've seen from today's data is that the Chinese market is all over the place. Retail sales have been up and down over the last 12 months. They've been falling for the last 3 months, and they're now down below that critical 5% target that the Chinese authorities have set. But when you look at what's happening with prices, they've only increased by 0.1% over the last 12 months. So Chinese businesses can't turn to the Chinese market because firstly, there isn't sufficient demand increases, and secondly, prices are static compared to where they were this time last year. So if Chinese businesses do sell into the Chinese market, it's likely that they'll be making a loss. And we've seen the data on the factory gate prices. They're down consistently in the last 18 months. So basically, if you're a business in China, over the last 18 months, you've had to absorb all the cost increases. So you've had to pay people more, you've had to pay more for things like electricity because costs have been going up, and all your raw materials that you're sourcing from overseas have gone up significantly. And that's hit the profitability of these businesses. And as we keep saying, profitability is key for a manufacturing business. If you're not turning a profit, then basically you're making losses. And the only way that you can fund that, if you can't bring in more sales, is to borrow more debt. So the overall summary of today's video is that the figures that we've seen for March 24 are highly concerning. Exports were down by 7.5%, producer prices fell by 2.8% year on year, and profitability of industrials in China was down by 3.5%. And this is all at a time when China is forecasting year-on-year growth of 5% for 2024. So these businesses need to turn things around rapidly, but unfortunately, they're not in control of what's happening because Chinese companies need the export markets to improve, and they also need the home market to improve. And as we've seen, producer prices are down, and so are inflationary prices in China. They've only increased by 0.1% over the last 12 months. So Chinese businesses can't really do much about this because the environment that they're selling into is very difficult. And what this all means, therefore, is that if this situation continues, China is very unlikely to hit its 5% growth target for 2024, and that's going to have serious repercussions for the Chinese economy. So hopefully you've enjoyed today's video, you found it useful, informative and thought-provoking. If you liked what I've said, then please give me a thumbs up. Thank you for watching this video all the way through to the end, and here's something to put a smile on your face.